As we approach the implementation of the Basel III regulations, a major concern is the financial risk profile of Tier 1 and Tier 2 banks. From your experience, looking at bank financial statements, what are your thoughts on the prospects for recapitalization in the banking industry?
When you look back, based on the crisis in 2007, there was now a need for a change in the thinking around the regulations of the banks. And that was part of what informed the Basel 1, 2, and now the implementation of Basel 3, which is currently running concurrently with Basel 2. And what is the focus of that regulation? It's basically trying to see how banks can be more regulated, how they can manage their risk, and as well as trying to see that they are sustainable in business-wise. So we have continued to see that even the economy is also evolving, and there's a need to change the way risk management is being done. Assessing the risk of a business, there's a need to change that. So when you look at the banks, for you to be able to quantify and assess their risk, you would require a certain level of capital to venture into those risks. And like we said, you can see that the structure of banking is changing. Even on the stock exchange, when you look at the banking sector, for you to capture that impact of banking, you need to look at financial services because of the holding structure that most of those banks are now taking that position to tap into other business and give flexibility to the banks. So it now becomes more difficult in terms of assessment. But as they go into those different areas, looking at what happened, we still recall the 2007, 2008, we called tsunami in Nigeria, bank tsunami that impacted on the banks. You would see that for most of the banks that went under then, had a lot of other subsidiaries that impacted on their profitability. Before regulations now came that they had to break away and sell those subsidiaries. Now it's like we're going back into that structure, holding structure, to give that flexibility, which means that risk management has to be stronger. The capital requirement now is better compared to before. When you look at the capital adequacy ratio for the banks, is higher, but there's a need to have close monitoring on those banks so that we don't have a repeat of what happened then. So the way I will wrap it up is that the adoption of Basel III, which when you look at the threshold, the capital adequacy requirement at 8%, I believe that for Nigerian banks, we are well more capitalized than that level. And if we also want to look at the capital adequacy ratio in dollar terms, that is where we know that if the benchmark is in dollar terms, there will be need for additional capital. But we don't operate mostly in dollars. So I would say that the focus now is for the new leadership of the CBN to see how they can allow banks make effective use of even the available capital. We see cash reserve requirements at 32.5. Yes, for merchant banks now at 10%. Why do we want to keep that amount with the CBN? Because indirectly, it impacts on the lending rates. If I'm collecting 100,000 from a customer and I can't generate income on 32%, it means I will sweat the remaining 70% to be able to cover the cost for the other 30%. And as a result, lending rates will be high because they need to cover all those costs vis-a-vis some of the other charges. So it's important that there's close monitoring. I won't recommend an increase in capital requirements now. The focus should be financial discipline trying to see how banks can increase credit to the sector, to the real sector, so that we can grow the economy as we get more clarity around the policy based on this new dispensation. Thank you.